Hello everyone, I am Sandip Agarwal. Welcome to my YouTube channel Financial Markets by CA Sandip Agarwal. So this is video number 3 under Options Intermediate Part 1 and video number 7 under the Total Option Series course. So after this we will have another video number 4 under Options Intermediate Part 1 and then we will move to a slightly more advanced version under Options Intermediate Part 2. I hope till now I have recorded 6 videos and you people are liking my videos and you are getting value additions from those videos. In case you are liking the content and getting value addition, so please like and subscribe to my channel so that you can get notifications to any future videos which would be uploaded, and also share the content with your friends and families so that they also get value additions from this. So let's start this video. So again, this 3-4 slides I'm just again repeating, which I have repeated in video number 1 and 2 as well under the options intermediate, because these slides you would be required to understand the later part of this video. So as we explained earlier also in the videos, there are basically 3 types of market. One is bullish, where person expects the market to move in the upward direction. Another is bearish, where the person expects the market to move in the downward direction. And third is the sideways, where the person expects the market to remain in a tight range or to move in a range of plus minus 1-2%. Then we have explained as well that what are the uses of the options. The options can be used for the purpose of hedging the portfolio. It can be used for the purpose of speculation, and it can also be used for the purpose of partial hedging and generating income as well. In case you want to understand these concepts again in detail, you can go and refer to my videos 4 under the basics of the options, where you will get a detailed explanation on these slides. Then what are the options types? So under the European and the American options, there are basically 3 types of options. One is ITM, which is in the money, another is ATM, which is at the money, and third is OTM, which is out of money. In this video, again, we will discuss only the speculation and the discretionary strategies, because under the hedging options, the types of strategies or the types of the options are very less. So whatever strategies we have discussed in the previous 4-5 videos as well, and in this video and in the upcoming videos, those will be only speculation or discretionary type of strategies. And these strategies can be applied in various types of market: bullish, bearish, or sideways. So as we explained earlier in the videos as well, that there are basically 2 types of option strategies. One is vertical spread and another is calendar spread. Till now, whatever strategies we have discussed under the speculation and the discretionary strategies were all vertical spread strategies. In this video also, we will cover further few vertical spread strategies, and then in the video number 4 of the options intermediate part 1, we will cover a couple of vertical spread strategies, and then we will move to calendar spread strategy in that video number 4 itself. So in this video under the vertical spread category, we will discuss 4 strategies. One is call ratio spread, another is put ratio spread, third is call ladder ratio, and fourth is put ladder spread. So basically this call ratio spread and the call ladder is basically a variation of the bull call spread. So if you want to understand the bull call spread again, you can refer to video number 4 under the basics of the options, in which I have explained in detail what is a bull call spread. So this call ratio spread and the call ladder is a variation of the bull call spread. And then similarly, this put ratio spread and the put ladder is a variation of the bear put spread. Again, this bear put spread I have covered in detail in video number 4 under the options basic, which you can refer for detailed explanation. So basically these 4 strategies which we would be discussing in this video are a variation of the bull call spread and the bear put spread. We will explain each of these 4 strategies by way of an example and the payoff graph as well in the upcoming slides in this video. Let's start. So what is a call ratio spread? So this strategy basically is used in case when the person is having a bullish view on the market or on any particular stock option. So In the bull call spread, the person basically buys an ATM call and sells another OTM call of the same underlying and the same contract. In the call ratio spread, the person basically sells another OTM call option of the same strike and thereby converts the bull call spread into a call ratio spread. So if you refer to the para 2 in this slide, the person basically buys an ATM call option and he sells another OTM call option. Now up till this is called a bull call spread. But when a person sells another OTM call option of the same strike of the same contract, then this bull call spread gets converted into call ratio spread. So this is basically a variation of the bull call spread. Under the bull call spread is a limited reward and the limited risk strategy, but once the person sells another OTM call strike, then this strategy gets converted into unlimited risk and the limited reward strategy. Basically, the bull call spread was the limited risk and the limited reward. The amount of the maximum profit and the amount of the maximum loss was defined. But the moment the person converts this bull call spread into call ratio spread, the maximum reward gets limited, but the risk gets unlimited. So we will see this by way of an help of an example in the payoff graph. So let me just maximize it. You see, basically in this case, what the person is doing, the person is basically buying 17,300 strike price call option of 24th Feb 2022 expiry contract of the Nifty, and he's basically selling two OTM call option, a 17,600 strike price of the same month contract of the Nifty. So you can see the maximum profit is capped at 11,620 and the maximum loss is undefined. Now, why this strategy is used? This strategy the person uses basically to reduce the cost of the bull call spread. In this case, if the person would have done this strategy of bull call spread, then he would have paid the premium 177 and he would have received a premium of 55. So in net basis, the person would have paid a premium of 122 rupees per one lot of this bull call spread. Whereas the moment the person is selling two a call option of 17,600 strike, then the person is receiving cumulative premium of 110. And in this case, the cost of this strategy becomes 177 minus 110, which is 67 rupees only. Whereas in the case of the bull call spread, the cost of the strategy was somewhere around 122. So you can see in the case of the call ratio spread, in case the market moves strongly in the downward direction, his loss is capped at 3,300 rupees only. Whereas his maximum profit is 11,620 and he is protected up to 17,833. So basically, in case the Nifty expires at a price which is either at 17,833 or below that, then the person will make a profit and he will not make a loss. Only in case the Nifty starts trading at a price which is higher than 17,833, then the person will make a loss. And you can see, in case the Nifty gives a very strong move on the upside, then his loss is also unlimited. You can see in case the Nifty ends at 19,000, then you can see the maximum loss is a 70,000. So this is a very high risk strategy, and these are mainly used by those people who are into the full-time trading, and they can manage their risk on day-to-day and real-time basis. So this strategy is basically used only when the person wants to reduce the cost of the strategy. Again, just a disclaimer, this is not a trade recommendation. I have just explained this for the purpose of giving you a practical understanding of what is call ratio spread. Now, similarly, like a call ratio spread, which was a variation of the bull call spread, similarly, there is a put ratio spread. This is again a variation of the bear put spread. In this case, the person expects the market to remain bearish. So he basically wants to enter into a bear put spread, but he wants to reduce the cost of the strategy of the bear put spread. Now, how he will reduce the cost of the bear put spread? He will go and sell extra OTM put option of the same strike of the same contract, and thereby will convert the bear put spread into put ratio spread. So basically in the bear put spread, the person basically buys an ATM put option and sells another OTM put option. This is called bear put spread. But the person wants to reduce the cost of this strategy. So the person sells another same strike OTM put option and converts the bear put spread into put ratio spread. Now again, in the case of the bear put spread, it was a limited risk and the limited reward strategy. But the moment the person converts uh, basically sales another OTM put option, this strategy gets converted into unlimited risk and the limited reward strategy. So we will explain this again by the help of an example as well as the payoff graph. So just maximize it. We can see again in this case the person has basically bought 17,300 Nifty put option of the Feb 22 contract at a price of 190, and he is basically selling two lots of 17,000 put option strike of the same contract at 93 rupees. So you can see in this case the maximum profit is restricted at 15,000 rupees and the max loss is limited. And if you do the mathematical calculation, you will see the person is basically paying a premium of 190 rupees and receiving a premium of 186 rupees. So basically his cost is almost nil. So the cost of this strategy in this case is very minimal, which is only 4 rupees multiplied by 50 quantity, which is the quantity for the one lot, so 200 rupees. But obviously his risk is unlimited. So if we refer to the payoff graph as well, you can see uh, in case the Nifty starts moving in the upward direction, that is, it basically becomes bullish, which is against the direction which was decided by the person. In this case, you can see the loss is only 200 rupees on the upside. So this is the advantage which the person is having by doing a put ratio spread in case his view goes wrong. But in case his view goes slightly correct in his direction, then the maximum profit is capped at 15,000 rupees. But in case the market becomes very bearish and Nifty gives a very strong move in the downward direction, then you can see his loss is also unlimited. In case the Nifty ends somewhere around 15,300, you can see the maximum loss is 70,000, whereas the maximum profit in this case, it would have been 15,000. So again, this is not a trade recommendation. This is only for the purpose of explaining the concept of the put ratio spread. And this strategy is basically used by those persons who are into the full-time trading and they can manage their risk and position on real-time basis. So this strategy is again used only in case the person wants to reduce the cost of this strategy. Otherwise, this strategy is not recommended. Now we move to the strategy number 3, call ladder. Again, this strategy is again a variation of the bull call spread only. In this case also the person expects the market to remain bullish, and at the same point of time he wants to reduce the cost of the strategy which he will apply in the case of the bullish scenario. So in this case also the person buys an ATM call option and sells OTM call option. This is called bull call spread. And in order to convert this bull call spread into call ladder, the person sells another call option strike of the different strike. Now just see the example, just see the difference between the call ratio spread and the call ladder. In the call ratio spread, the person was selling another OTM call option of the same strike. So the first strike for which the call option was sold, the person sells another OTM call of the same strike. Whereas in the call ladder, the person sells another OTM call strike of not the same strike but a different strike. So in case a person selling two OTM call option against buying a one ATM call option, then that strategy is called as call ratio spread. Whereas when the person buys an ATM call option and sells two different strike price OTM call option, then it is called a call ladder. This is again a variation of the bull call spread, and it converts a limited risk and limited reward strategy into an unlimited risk and unlimited reward strategy. This is basically the example and the payoff graph. You can see In the case of the call ratio spread, we have seen the person has bought 17,300 strike price option of the Nifty for the FIP contract and sold a two lot of 17,600 strike of the FIP contract, whereas in this case the person had sold only one lot of 17,600 strike and he had sold another lot of 17,800 strike. So in this case, the cost of the strategy will be bit expensive as compared to the call ratio spread, but his risk could also be slightly better. So if you go and rewind the video, you will see in the case of the call ratio spread, the probability of the profit was somewhere around 29%, whereas in the case of the call ladder, the probability of the profit gets improved to 32%. Obviously, the max profit gets slightly lesser, but the risk also gets lesser. You can see the payoff graph as well. The profitable range for the person is in case when the Nifty expired somewhere around 17,400 to 18,000 approx in the month of Feb. Whereas in case the Nifty expires at a price which is less than 17,400, then his loss is capped to somewhere around 6,000 rupees. Whereas in case the Nifty starts moving in a very strong direction on the upward side, then you can see his loss is also unlimited. So again, this strategy is again used by those persons who are into the full-time trading and who can manage their positions on a real-time basis. So this is again not a trade recommendation. This is only for the purpose of explaining the concept of the call ladder. So this strategy is again used only when the person wants to reduce the cost of the strategy as well as also wants to reduce his risk. So the call ladder is slightly less risky as compared to the call ratio spread. If the person wants to play safe, then the person can go only into the bull call spread and do not touch the call ratio spread and the call ladder. So if we arrange these three categories, one bull call spread, another call ratio spread, and third the call ladder into the priority of the risk, then the bull call spread is the least risky. After that, it comes call ladder, and the most risky comes the call ratio spread. So similarly, on the put side, as we have explained, put ratio spread. Similarly, we can also do a put ladder as well. So in this case, also the person expects the market to remain bearish. At the same point of time, he wants to reduce the cost of the bearish strategy. So basically, the person enters into a bear put spread where the person buys an ATM put option and sells another OTM put option. Now, in order to reduce the cost of the strategy, person sells another different strike price OTM put option and convert the same into put ladder. Similarly, in this case, also in the put ratio spread, the person was selling a same strike two lot of the same strike, whereas in this case, the person is selling two lot of the different strike price OTM put option. This is again a variation of the bear put spread, and it converts a limited risk and limited reward strategy into the unlimited risk and the limited reward strategy. So this is the example. So if visit zoom out. This case also you can see the person has basically bought a put option of 17,300 strike price of Feb 22 contract, and instead of selling two options of the same strike price 17,000, in this case the person has sold one option of 17,000 strike price and another option of 16,800 strike price. So obviously the cost of this structure is a bit expensive as compared to the put ratio spread, but you can see the probability of the profit also gets increased and the risk also gets decreased. You can see the maximum profit in this case is capped at 13,000 rupees, and the profitable range for the person in this case is 16,539 to 17,261. So in case the Nifty stays in this range and expires within this range only in the month of Feb, then the person will make profit in this strategy. We can see the payoff graph as well. In case the view of the person goes wrong and the Nifty starts moving in the upward direction, you can see the maximum loss in this case is 1900 rupees only. Whereas the person would have gone into the bear put spread, and if the view would have gone wrong, then the maximum loss would have been 190 minus 93, which would be around somewhere around 100 multiplied by 50, which is 5,000 rupees. So again, this is not a trade recommendation. This is only for the purpose of explaining the concept of the put ladder. Similarly, if we arrange the strategy under the bearish side, between bear put spread, a put ratio spread, and the put ladder. Then the bear put spread is the less risky. After that, it comes the put ladder, and then only comes the put ratio spread, which is the most risky strategy in these three strategies under the bearish market structure. So that's it from my side. I hope you people have liked my video. So in case you have liked, please do like and subscribe to my channel. And in case you have any queries, please give your queries in the comment box, which I will try to address in the next video. That's it from my side. Thank you.